Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fajita, and let's get you up to speed. We've got an hour to go in the trading day. You're looking at stocks off the lows of the session, but all three of the major averages declining. Strong readings this morning on both the services and manufacturing sectors, worrying some investors out there that maybe the Fed isn't done raising rates. So with an hour to go, you're looking at the Nasdaq, the worst performer of the three major averages, off just over 1%. Big tech among the names hit hard in today's session. You have Apple, the worst performer in the Dow today. And as we see declines in equities, let's take a look at the action that we're seeing in the bond market, because Treasury yields pushing to the upside. The 10-year yield once again rising up another just about 2 basis points today, just below 4.3. Akiko.
Well, Shauna, one of those names we're watching closely today is Apple. China reportedly banning government officials from using Apple's iPhones and other foreign branded devices for work. The Wall Street Journal is reporting that officials were notified in recent weeks through chat groups and meetings. And the ban, of course, comes just weeks before Apple's set to release its latest iPhone. Shares there down nearly 4% today. Shauna, the stock move is an interesting one for me because on the one hand, when you look at what has been reported by the Journal on its surface, it's tough to say how significant a hit that would actually be, because we're talking strictly government officials that would be banned. It's sort of similar to what we have seen play out here in the U.S. with TikTok. Government officials haven't been allowed to use TikTok, but that hasn't really affected the user numbers for the app. So that's what it appears to be on the surface. Now, I think the big concern here is that this is such a significant market for Apple. They get roughly 20% of the revenue from China. Is this just the beginning and a sign of things to come as we see the U.S. and China tensions intensifying?
Yeah, exactly. And you're exactly right there, Akiko. China just so important to Apple for its revenue here, given the fact that they get about a fifth of their sales from the country. But when you take into account what this could mean, some of those ripple effects across the other names within the tech sector, D.A. Davidson's Tom Forte was highlighting some of that risk today. And he was saying that the fact that Apple is not immune here, a company that employs hundreds of thousands of people within China, really just shows that China is not afraid to potentially ban any sort of company, any sort of product that they could potentially see an issue with when it comes to security. And this is just the latest, like you said, that tit for tat back and forth between the U.S. and the Chinese government officials there. We have certainly started to see maybe hints of some improvements, some increased dialogue between officials, but then you get news like we potentially have today, this Wall Street Journal report saying that there is a long way to go, and many U.S. companies, at least here in terms of potential China bans, could have some challenges here in the coming months.
Yeah, there have been conversations happening between the U.S. and China, but at the end of the day, the concerns around national security, specifically data collection, not expected to really thaw here. And that appears to be the concern. I mean, you could argue on the one hand, this is a tit for tat. What the U.S. has done to companies like Huawei as well as TikTok, China is trying to do to Apple. That's one theory. Now, at the same time, if you think about what the concern is on terms of national security, it's been the same on the U.S. side as well as the Chinese side, which is data collection. Also, you could argue China looking at some of those sagging sales for their homegrown names like a Huawei. If you ban on some level Apple products, that could potentially give a lift to Chinese companies as well. But one more number to leave you with on this story, at least, Shauna. Bank of America saying that if there were such a ban to be enforced, they're looking at a headwind for Apple anywhere from 5 to 10 million units. So tough to still gauge what the impact is likely to be, but there are concerns. This is the first step in what could be a chilling effect in China.
Yeah, and also remember that this is potentially coming ahead of the highly anticipated new iPhone that we're expecting next week. We know Apple has a lot riding on this potential new model here, given the fact that we've seen a couple of quarters of declining iPhone sales. Let's also talk about another mover today. WeWork is doing all it can to survive. CEO David Tolley writing in a public letter that the company is renegotiating nearly all of its leases and also plans to exit, quote, unfit and underperforming locations. The letter following WeWork's warning last month that there was, quote, substantial doubt about its ability to stay in business. Despite this, though, The stock's still under pressure, off another 5% today. And Kiko, you and I have talked time and time again just about the road ahead for WeWork. Obviously, it's going to be extremely hard given the macroeconomic conditions, given the trouble that we're seeing play out across the office sector, across commercial real estate. But when it comes to WeWork and their locations, they still have 777 locations globally as of the end of June. That's a heck of a lot of locations given the fact that occupancy and also membership fell again in the second quarter from the first quarter. So they're trying to do all they can to rein in some of their costs, save money where they can. Their ability, though, to renegotiate some of these leases with landlords, how flexible some of these landlords are going to be, that's the big question.
You mentioned those 777 locations. That amounts to roughly $13 billion in long-term lease obligations. And sure, that's down significantly from Adam Newman's days, which exceeded $18 billion. But there's a few things that stood out to me in that letter that Dave Tolley put out. You know, one, he said specifically that current lease liabilities amount to over 2/3 of total operating expenses in Q2, specifically saying that is dramatically out of step with current market conditions. The company's saying they plan to take immediate steps to fix inflexible and high-cost lease portfolios. But, you know, Shauna, I guess the question here, and we've gotten a number of answers from guests we've had on the show, which is how significant would it be if WeWork were to go under, whether in fact they were not able to meet their leases? And that seems to still be sort of a mixed bag. Manhattan, for example, you know, they accounted for roughly a quarter of new leasing activity in New York. But when you consider just how many offices there are, it's still a small share.
Yeah, very small share. But at least for New York, and also we talk about the fact that when we talk about office landscape, office real estate here, commercial real estate, but specifically the offices, there's a huge divide, right, between the Class A properties and some of those underperforming properties, some of the cheaper properties. And there was actually a report out here where a number of retail executives in recent weeks saying that this trouble here with WeWork, that could actually further that divide between the Class A properties and the more dated ones, given the fact that a number of WeWork sites are in some of those lower quality buildings. So even if it's with a city as large as New York, even if it's more of a New York specific story or a story more specific to some of those larger cities across the nation, still though, you think those ripple effects would have some sort of impact across the industry. All right, T-Mobile shares reversing some of their earlier gains, now off just about 2.5%. The stock initially spiking after the company announced a $19 billion share buyback program through the end of 2024. It also plans to pay its first dividend in the fourth quarter. Here with more on that and the wireless landscape overall from the Goldman Sachs Communacopia and Technology Conference in San Francisco is Yahoo Finance's Brian Sozzi. Saz.
All right, thanks so much, Shauna. Yes, joining me now is T-Mobile CEO Mike Seaver. Mike, I've talked to you from a kitchen table in the middle of a pandemic, a couple weeks ago in a hotel room, and finally in person.
Well, thanks for coming all the way out to San Francisco, Saz. You look like New York, though.
Well, I look That's good. It was the suit, right? So talk to us about, Shauna just mentioned on the other side, about the new dividend, about the new stock buyback. What's your message to investors having pulled the trigger on both those things?
I think what investors expect from us is ongoing, reliable growth. Profitable growth that translates into industry-leading cash flow growth. And that's what we deliver. And we've been delivering it consistently over time, such that we believe it's time to make the next installment of our long-standing aspirations around shareholder remuneration. And in 2021, we laid out an aspiration that was big and bold, that we saw up to $60 billion in shareholder returns during our planning horizon. And this is the second installment, $19 billion over the next 5 quarters. And as a part of that, our first ever dividend, a $3 billion annual dividend. That's $3.75 billion over the 5 quarters that we see increasing at about 10% a year within our much larger cash flow envelope of outlooking something like $16 to $18 billion next year.
Don't run off the set when I ask you this. Don't pull off the mic, because when I think telecom, dividend payer, I'm thinking potentially slower growth. Do you see, is T-Mobile now a stodgy telecom company? Because I think a lot of investors on our platform only know you for strong earnings growth.
Far from pulling off the microphone. That's a really important question. And look, we are outperforming this whole sector on growth, and our capital priorities have not changed. It is to fund this historically great business plan, and both organic, inorganic, core business as well as adjacencies. Secondly, to get our business on the stable footing of a leverage around 2.5 times. About mid-twos has been our long-term leverage aspiration. And we're going to move there next year because of the wider rate environment. We think it's smart to move there a little faster than planned. And third, to return all that massive cash production to shareholders. And it's time for us to start doing that in a more evergreen, reliable format because those cash flows are now evergreen and reliable. And it's a big moment for our company.
So T-Mobile, still a double-digit earnings grower.
Well, listen, last quarter, to put it concisely, was the biggest postpaid net addition quarter in 8 years and tied for the biggest in our history for a Q2. That's huge. And we translated that into industry-leading service revenue growth at the consolidated level, as well as postpaid wireless, the stock you buy and the place where all the value is created. And we translated that into double-digit EBITDA growth, highest in the industry, and then translated that into the highest cash production in the industry, not just in terms of overall growth, outlooking 75% year-over-year free cash flow growth this year, but in terms of cash production per revenue dollar. We'll be north of 20% cash flow margins as a percentage of service revenue this year, best in the industry by far, and only going in one direction.
Fair enough. Are there cost savings left from the Sprint acquisition?
Yes, we're at a run rate synergy of around $7 billion out of $7.5 billion. We see a little bit more room to clean that up. But really, from here, it's about executing our business plan. And after 3.5 years of integrating our business, we have a fantastic company that's really performing, but we have to make sure that we're our best version of ourselves. And we've been making changes to make sure that we're not just successful this year, we're successful 3 years from now. Some of those changes are a little difficult. We had to execute a reduction in force this month, but that's to make sure that our company is super successful 3 years from now, and that we're able to be the best version of ourselves, fast and nimble, competitive, entrepreneurial, the kinds of cultural traits that created this success in the first place.
Investors that have jumped aboard the T-Mobile growth story all these years under John Legere, now you, of course, the CEO, John, of course, the former CEO, they're not used to seeing layoffs, Mike. I think this is something that came as a surprise to a lot of investors.
Yeah.
Did you feel pressure to do it, and are you done doing
Well,
it?
it wasn't a decision we took lightly because this is not a normal thing for a company like ours. We wanted to do it in such a way that it really was about the people who are staying, which are the vast majority of employees. Every employee deserves to know that they are working on something important, that their role's not duplicative, that they work within a management structure that's fast, efficient, and decisive, allows them to get their work done so that we can really execute in what is a really competitive environment. And that means being very efficient. So yeah, we told employees in my letter to them, we were doing this now, and we want every employee that's staying, which is the vast majority, to know, that this is going to be a better place to work and that there isn't another shoe to fall.
You mentioned competition. We have heard recently, the past few weeks, more price competition from the cell phone carriers. Are we going back to new price wars, or is that just a thing of the past?
No, it's just that the nature of the competition keeps changing. Now, we did bring extra competition, just like we promised we would when we created this merger, and it's more competitive now than it was a few quarters ago, mostly due to the dynamics of our merger. But the nature of it is what's changing. Right now, customers want a fantastic deal on a smartphone. Those smartphones have gotten a lot more expensive, and they're now relying on the carriers to help them afford those. And so that's where the nature of a lot of the competition has gone. But on the other hand, they're willing to pay up on the rate plan side to get some of those smartphone subsidy benefits. And so, the nature of it keeps changing. What makes us distinguished is we're guided by customers. We just keep listening to customers and changing how we execute so that we're always able to deliver an overall better value. Because ultimately, post-merger, what customers expect from us is the best network, backed by the best 5G and the best asset portfolio, and the best value, backed by the best balance sheet. And we're the only ones that can give them both.
Is there any cell phone bill relief coming at all at any point, or do you just have unlimited pricing power because we need our phone? I'm not getting rid of my phone.
Well, quite to the contrary. This has been a massively deflationary market over the years. What customers get for what they pay now is better than ever. And wireless has been one of those sectors that has been contra to the inflationary trend where a per unit pricing against consumption in wireless is the best now that it's ever been. And by the way, we spend tens of billions of dollars to build these historically great networks, and yet translate that with a better value over time to customers and still deliver cash flow aspirations in line with our expectations. So, we have to thread the needle against all these stakeholders, and so far it's working beautifully.
Last 15 seconds, you excited about the new iPhone?
Absolutely, we always are this time of year. Can't wait to see what they come out with.
All right, yeah, me too. I'm about due for a new iPhone. Mike Seaver, T-Mobile CEO, thanks for making time for us. It's a very busy conference. It's lunchtime. Let's go eat some food.
Yeah, glad you guys are here, Saj.
All right, appreciate it. All right, Shauna, back to you in New York.
All right, Brian, thanks so much. We're going to have more from Brian here throughout the next couple of hours. Let's talk about the latest moves that we're seeing here in the market. The Nasdaq off just over 1%. The threat of rising rates is taking a toll on tech stocks today. Jared Blickery is here with a closer look at some of those technical moves that we're seeing in the sector. Jared.
Yeah, so we're looking at some of the worst days here, particularly for Apple and NVIDIA in about 4 weeks. Let's pull up the technicals for Apple. This is over 6 months. I put candlesticks here, and I'm going to put on the 50-day moving average so you can see how previously when we were descending from these highs, we skipped right below it. That was a huge down day. We were descending pretty rapidly in here. I did a study at the time that saw that when Apple falls from a record high very quickly, it tends to be prolonged. In other words, that drawdown tends to be prolonged. And indeed, we came right above the 50-day, and now we are selling off strongly from it once again. That is a clear technical signal that we are to be on alert for further downside potentially. Now I want to take a look at NVIDIA. I'm going to put a 3-month chart. This big red candle up here, that was a record high, by the way. That occurred on its earnings day, and there was some interesting action with respect to buybacks. They sold about $1 billion worth of stock at $499. I'd never seen that price before, so that was potentially exit liquidity for some insiders. I think the main point here is that NVIDIA has not been able to climb above that high there. So even though we are still close to these record highs, I would be a little bit cautious at this point. Now I want to go to XLK. That is the Spider S&P 500 Technology Select Fund. And I'm going to put a 5-year chart on here so we can see what's happening and put some lines there. I've heard some rumblings on Twitter. Tech is setting up for a huge double top here, and here's how this would play out. However, you'll notice that we are missing this final down leg here, and in fact, you would have to breach 120 decisively to the downside in order to get that topping formation. Right now, we could easily skirt to new highs. I do want to see a break above these highs here eventually, especially to confirm strength, but for now, I think tech is in a decent position. I'm going to show you Microsoft. Microsoft also in a very similar chart, but also decent position. And then just finally, on the tech note, software versus stocks. That is the chip stocks. Software over the year to date, that is actually, the stocks is actually outperforming year to date. However, over the last month, you will see that software has come from behind. And so software indeed looking a little bit better than the chip stocks at this stage. Shauna.
All right, some trends that we'll keep an eye on. Jared, thank you.
Let's do a quick check of the markets sponsored by Tastu Trade. We are seeing red arrows across the board right now with about 45 minutes left to go in the trading day. The Dow down 181 points, the S&P 500 down 32, and then the Nasdaq down 164, yet again on concerns about potential rate hike coming from the Fed based off of new economic data we got out earlier today. Well, we're just getting started here on Yahoo Finance Live. Coming up, Transportation Secretary Pete Buttigieg joins the program to recap the summer travel season and break down the impacts of a potential government shutdown. That conversation is on the other side of this break. And in the 4 p.m. hour, we head back out to the 2023 Goldman Sachs Communacopia and Technology Conference as our very own Brian Sazzi catches up with AT&T CEO John Stankey. That and much more when Yahoo Finance returns.
The summer travel season is done, and now we are into the fall travel season. Let's dive into all things travel and transportation here with Transportation Secretary Pete Buttigieg. Mr. Secretary, always nice to get some time with you here. So we're done with the summer, getting ready into the fall travel season. But before we even start our fall travel, we had news this week about United Airlines having trouble or computer glitches or whatever it might have happened there. Have you talked to United Airlines, and do you think that is indicative of airlines underinvesting in their platforms?
Well, you never want to generalize too much from one case, but this is not the first time this year that we've heard about the technology issue, the issue that we saw earlier at Southwest Airlines. We had an issue with the FAA. So clearly, in terms of keeping the aviation system operating smoothly with the pressure that it's under, there's going to need to be continued attention to technology. I did speak to the United Airlines CEO yesterday as the situation was developing. They were able to get on top of it pretty quickly and get service back to normal. But certainly, I think points to the role that technology increasingly plays, not just the onboard technology. And of course, we spend a lot of attention here at the department certifying and looking after the safety of aircraft technology itself, but everything around that, from dispatch systems that airlines use for their operations to the various communication systems that the FAA uses for ours. And of course, across all of that, our top priority is always going to be safety. And then once safety is seen to, you got to make sure that the operations are looked after. But the good news is, overall, you look across the Labor Day weekend, at the end of a summer that's on all-time record high in terms of the number of Americans getting onto airplanes. We saw less than 1% of flights canceled, less than 2% of flights delayed. We're not satisfied or sitting back, resting comfortably, but very encouraged by the results that we saw that holiday weekend and generally speaking over the course of the summer.
These tech delays, Mr. Secretary, that seemingly come out of nowhere, should flyers just expect these things to happen this fall and even into next year as technology plays a greater role in our lives?
Well, the big thing I want flyers to know is that when there's a situation that an airline is responsible for, and certainly a mechanical failure or an IT failure delaying or canceling your flight is an example of that, you have recourse. We are enforcing customer service agreements that are dramatically improved compared to where they were just a year and a half ago after everything passengers went through last summer and the pressure that we put on airlines. So we're encouraging passengers to go to flightrights.gov so you understand if you do get stuck in a situation like that an airline is responsible for, what you can expect and what you can be guaranteed in terms of coverage for how you get rebooked, having your expenses covered while you're on the ground, meals, hotels, that kind of thing. The best scenario, of course, is for that kind of disruption not to happen in the first place. When it does happen, we want to make sure passengers know that our department has your back.
The New York Times recently reported, Mr. Secretary, close calls or an increasing number of close calls on the tarmac. Why do you think this is happening? You know, we haven't had a major aviation disaster in some time, but I think consumers seeing these stories are like, wow, what's going on here and what can be done to prevent something catastrophic from happening?
Well, a lot goes into maintaining the safety record of our airspace. We have the safest, most complex aviation system in the world. Amazingly, flying is actually the safest form of travel by far in the United States. But we don't take that for granted or sit back with that, which is why now, even a situation that was out of the norm, let alone an actual incident, is going to get the kind of attention that used to be reserved for when there was an actual collision in the past, something that hasn't happened in over a decade in the United States. And again, lots of work goes into keeping it that way. Keeping it that way for the future includes making sure we have the right kind of technology. It means making sure that there's the right kind of training and attention. We're pushing a lot right now on situational awareness, communications, sterile cockpits, good hygiene that everybody, whether in the tower or in the flight deck, needs to maintain. The other thing I would add is that what would not help us in the progress we're making right now is a government shutdown. You know, this is a very good and important example of why non-defense spending in the federal budget is very important. If we went through a shutdown, a lot of the progress that we have been making on building up air traffic control staffing and readiness and training would be stopped in its tracks. We would lose the momentum that we've gained over recent weeks and months, and it would send us in the wrong direction. So one of many, many reasons we're looking to Congress to do what it takes to fund the FAA, fund the government, and keep things moving.
There has been some chatter on the other side of the aisle, the Republican side. Maybe they should push for a government shutdown. Just from your vantage point, how terrible would that be for the U.S. economy? You're talking about, flights being ground to a halt potentially, and a lot of other things that could be really damaging.
Look, this would be a mess for the U.S. economy, even if they keep the bare minimum up and running in terms of having the air traffic control towers open. We would lose the trainees who are part of the operation there. A shutdown, even lasting a few days or a week, could set us back by months in terms of the training pipeline for controllers, because of everything that goes into building that kind of experience and keeping it current. So you look at aviation, which is in the neighborhood of 5% of our GDP, that alone would be dealt a really serious blow to the momentum that we've been seeing from a shutdown. It's one of many, many examples why this is not, they're playing with live fire here. This is not theoretical. This is not academic. This is direct damage to the U.S. economy that can and in our view must be avoided and be prevented. I don't think there's any justification for playing political games with something as important to our economy and as important to our economic and national security as keeping the federal government up and running and serving the American people.
And lastly, Mr. Secretary, I know this doesn't fall under your direct purview, but we're at a pretty interesting moment in the UAW negotiations with the major automakers. If an agreement isn't reached and these workers go on strike, maybe that's one less car produced. Maybe one person won't be able to get to work. What do you think that does to our economy? And does it feel like a very big moment for the labor movement in this country?
I think the moment you're seeing with the labor movement is a recognition that there are big changes and developments coming to the auto industry, and the UAW wants to make sure that workers benefit from those changes. Look, I grew up in a town that was shaped not just by the auto industry generally, but by the achievements of the UAW specifically. We're the hometown to Local 5 and Local 9 back in South Bend. And so I've seen directly how the middle class and the prosperity of whole communities is shaped by the ability of auto workers to get a fair share of the wealth that they create. Now, of course, they need to be at the table working with the auto companies that have a business to run and need to make sure that sector succeeds. And so our role has been engaging the parties and urging them to come to a negotiated solution that spares the American economy the impact of a strike, and that also ensures that workers do right by the extraordinary opportunity in front of us. Not that long ago, a few years ago, we were talking about a manufacturing recession here in the United States. Now we're seeing a manufacturing job boom. I was just back in Indiana, where I grew up, and drove the road from South Bend to Indianapolis past a massive facility under construction outside of Kokomo that is just one example of the auto supply chain and industry construction and development happening right now. We need to make sure we keep the momentum for that economic manufacturing growth, and as the UAW is seeking to ensure, have that development happen in a way that benefits American workers.
Transportation Secretary Pete Buttigieg, always great to get some time with you. Thank you for talking about a lot of really important issues with Yahoo Finance all the time. Thank you so much.
Same here. Always good to be with you. Thanks.
And we will be right back after this short break.
Did Dan Howley go all the way to Seoul for some light shopping? He's no doubt a tech aficionado and the citizen of the world. You need to know what he's up to. We'll find out when Yahoo Finance is next.
It's not enough to know what's happening now. You need to know what's happening next.
I'm Dan Howley, and this is What's Next with Samsung.
People put it in the water.
That's pretty gnarly.
Water.
This is the heart and soul of Astrobotic. This is where we build our landers that can go to the surface of the moon.
Is the future high power, bigger boats? How easy is it to take the battery out, do the charging thing?
Imagine being able to charge without ever plugging in. It's becoming a reality thanks to technology that's hidden beneath my feet. We'll show you what tomorrow will look like today. Join us for our new series next.
Well, the Fed's Beige Book is out detailing the health of the economy across the Fed's 12 districts. Jen Schomburger has been going through it and joins us now. And Jen, it does point to a bit of a slowdown that we've seen reflected in the economic data.
Yeah, hey there, Akiko. Yeah, the Beige Book tracking that data, as you mentioned. The Fed's Beige Book pointing to signs that inflation and wage growth could slow later this year. The Fed's Beige Book revealing today that businesses in several districts struggled during August to pass on costs to consumers as the cost of making goods are growing faster than the prices businesses are selling them for, that cutting into profit margins. Anecdotally, in New York, firms said that consumers have become more price conscious and that price is often the most important factor when determining whether to make a purchase. Now, most districts reported price growth slowed overall, slowing specifically in manufacturing and consumer goods sectors. When it comes to the job market, job growth was mostly subdued across the country. Why? Companies are still finding it difficult to find workers with the proper skill sets. That is helping to keep wages buoyant. However, companies expect that trend to flip in the fall, saying that they expect a broad slowdown in wage growth. Now, officials will use this information in 2 weeks for their policy meeting, where they're widely expected to hold rates steady in the range of 5.25% to 5.5% as they continue to track this cooler data that we've been seeing on both the job and inflation fronts. This Beige Book really keeping in tow with the most recent data that we've seen. Back to you.
Jen Schomburger with the latest on the Beige Book. Thanks so much for that.
Well, inflation has been showing signs of cooling off, but it may be short-lived. Energy prices spiking in recent weeks, with crude now trading at the highest level that we've seen in nearly a year, just below $90 a barrel. We've already heard from airlines warning of higher fuel prices. So the question now is whether this could affect the narrative that the economy is definitely heading for a soft landing. Let's talk about that and more with Mark Zandi, Moody's Analytics chief economist. Mark, it's good to see you. Thanks for joining us.
Thanks for having me.
So here we are with crude prices rising steadily, just shy of $90 a barrel. When we think about this in context to the Fed's fight against inflation, how problematic is this potentially?
It's potentially problematic. I mean, the economy is performing well, growth is slowing, inflation is moderating, everything is consistent with a soft landing. But, you throw in the mix higher oil prices, if they keep going higher and stay higher, that could be a problem. There's nothing, more deleterious to the economy than higher oil, gasoline prices. It slows growth, it sucks purchasing power of consumers, and it adds to inflation expectations. It undermines consumer confidence. There's nothing worse than higher oil prices. So hopefully we don't see oil prices go much above $90 a barrel for any length of time, because that could be problematic.
No question, oil prices, one of many factors the Fed is watching. We heard from Boston Fed President Susan Collins this morning, talking specifically about the patience that's needed right now, that the Fed needs to keep its optionality still, potential for an additional rate hike. As we talk about what this landing will look like, I mean, where are we in that landing? Forget soft and hard. Where are we in that process right now?
Well, I think we're pretty far along. It's feeling pretty good, right? I mean, we're seeing resilient job growth, but it is slowing to script. The Federal Reserve is working hard to get job growth down to something that's more consistent with the growth in the labor force, allow the labor market to ease up a little bit, and that's happening. Hiring rates are down, the number of unfilled positions still high, but that's come in. Quit rates are down. compared to where they were a year ago. Layoffs have picked up a little bit, but they're still low. So by that standard, it feels pretty good. The soft landing seems like, is on track. Then, of course, we just talked about inflation, barring higher oil and gasoline prices. I think underlying inflation will continue to moderate and consistent with a soft landing scenario. I don't think we can declare victory, though. I mean, I don't think we can say we've soft landed until it's clear that inflation is back to the Fed's target and the Fed is actually beginning to cut interest rates. That feels like that could be a while, probably this time next year. So all the trend lines look good. Everything feels like it's on track, but still a ways to go here.
Mark, do you still think that 2% inflation target, does that still make sense? Is that still appropriate?
Great question. I think they need to strive for 2%. I mean, they have to keep inflation expectations tethered because by so doing, they make it easier for us to actually get inflation down. So I think the Reserve needs to continue to state and focus on that 2% target. But, Shauna, once you were in the kind of below 3 in the 2s, I think they can become much more relaxed about, getting it down to that 2% target quickly. Because, at the end of the day, if you were going to pick an inflation target today, given everything you know about the economy and the underlying growth rates, you probably would pick a target inflation rate that's probably closer to 3 than 2. So once we get into the 2s, I think the Federal Reserve becomes much more relaxed about getting it actually down to 2. But in the meantime, they got to stick to that message. They got to keep inflation expectations tethered.
When you look at where things could be going, you've got this report out of Bloomberg talking specifically about the Fed looking to potentially boost growth projections. You look at where the Atlanta Fed is, potentially expanding to 5.6% when you look at growth on an annualized basis. I guess, number one, is that sustainable if that's what we're looking at? And what does this ultimately mean about where the Fed is headed then?
Yeah, I don't think the economy has grown 5.6%. No, I mean, it had a pretty good July, and I think that's what's reflected in these so-called tracking estimates that are based on, all the monthly data that is available at this point in time. But my sense is that once we get the August and September data, we'll see an economy that's still growing somewhere around 2%-ish, kind of close to the economy's potential. And I think that's roughly where the economy is. But here's some good news in that regard in terms of growth and inflation. It does feel like the supply side of the economy is stronger than we thought. If you look at labor force growth, for example, the supply of labor, that's been extraordinarily strong. Labor force participation picked up in August, and the labor force expanded by over 3 million in the past year. That's pretty darn good. And then the other thing that's happening is productivity growth seems to be kicking back into gear. It was quite depressed back a year or two ago, but it feels like it's starting to get some life back. So you get more labor supply, you get some more labor productivity growth. That allows the economy to grow a bit more quickly without generating inflationary pressure. So, I think it still feels like we're in a 2% economy, and I think that's sustainable.
Mark, do you think the strikes at all could potentially change the dynamic that we have currently right now, at least over the last couple of months, is slowing a growth here within the labor market, but we still have the 2 unions on strike in Hollywood. We have the threat of the UAW strike looming. I guess, how do you see that impacting the labor market here over the next several months?
Well, the strike would have to drag on for an extended period, a long period of time, more than a few days, more than a few weeks, probably more like a few months for it really to add up and have a very large impact. And I'm speaking most specifically about the UAW strike. That's probably the most serious threat to the broader economy. But it's small in the grand scheme of things. So it'd have to drag on for a long, long time. I mean, if you're kind of scouring the planet for things to worry about, oil prices are number one. You say second on the list is probably the potential for a government shutdown. The UAW strike, the labor market actions, they're on the list, but kind of towards the bottom of the list.
Mark, how likely do you think a government shutdown will be or is?
Well, I think it's more than likely. I'm hopeful that it will only last a few days, no more than a couple, 3 weeks. I mean, I think the political pressure for Congress to get it together and for them to sign on the dotted line to fund the government are going to intensify pretty quickly. As soon as federal government employees don't get their paycheck, I think there's going to be a lot of political pressure to get it done. So I think pretty good chance we'll see a few days of shutdown, maybe a couple weeks, but I'm hopeful it doesn't extend beyond that. But that could be, if that lasts for very long, that could add up. So just a rule of thumb, for every week the government shuts down, that shaves 0.1% off of annualized GDP growth in the quarter. So if the government shut down on October 1, it didn't reopen until January 1 of next year, that would shave 1.2 percentage points off of fourth quarter growth. And in an economy that's growing 2, that's a lot of growth. So we don't want to see that. I don't think we will, but that gives you context.
Hopefully we don't. All right, Mark, always great to get your perspective. Mark Zandi, Moody's chief economist. Thanks.
Thank you.
Coming up, Roku shares getting a boost after revealing plans to cut more jobs. We've got that for you coming up.
Now, from the Lower East Side to the heart of Seoul. For some men, I guess all the world is a catwalk. But why is our tech wizard Dan Howley strutting down one of the Korean capital's most famous shopping streets? Well, we're not going to tell you just yet. Find out on Yahoo Finance's next.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Roku shares gaining after announcing plans to cut more jobs, looking to gain just about 2%. Here with the latest Yahoo Finance's Alexandra Canal. Allie.
Hi. Yeah, so Roku shares, they were up as much as 14% earlier in the session. So giving up the majority of those gains, likely dragged down by the broader markets, with the Nasdaq now down pretty significantly. But that initial boost came on the heels of more cost-cutting initiatives. The company revealed in a regulatory filing earlier this morning that it'd be eliminating 10% of its workforce, which translates to 300 jobs, in addition to slowing down the pace of hiring. And it's important to note here, this marks Roku's third round of layoffs in less than a year, after it cut 200 jobs in March 2023 and then another 200 jobs in November 2022. So not immune to the layoffs that we've seen in the tech space overall. Now, in addition to those layoffs, the company also plans to reduce its office footprint and remove select content from the Roku streaming platform. That will result in a slew of impairment charges, but excluding those charges, Roku also raised its guidance for the third quarter. It now expects Q3 revenue in the range of $835 million to $875 million, with adjusted EBITDA in the range of negative $40 million to negative $20 million. Now, this is ahead of its previous forecast for revenue of roughly $815 million, with adjusted EBITDA of negative $15 million. And analysts overall were very bullish on the heels of this news. JP Morgan reiterating its outperform rating, saying it's especially impressive considering the ongoing double strike in Hollywood, which has had a significant drag on ad spend, particularly that ad spend for media and entertainment. So likely the fact that they boosted their guidance means that they're seeing ad growth in other areas like travel, health and wellness, which they did say in the second quarter as well. But clearly investors are bullish on these cost cuts and the future of this company.
Certainly, it looks like at least Roku trying to get its company in a better position than it has been. And we know that certainly has been a drag here on the stock rate. Allie, thanks.
Well, another tropical storm is churning in the Atlantic, packing winds of up to 65 miles an hour. Forecasters say it's too early to predict Tropical Storm Lee's path, but it is expected to intensify into a Category 4 hurricane as it approaches the Caribbean. This comes just days after Hurricane Idalia devastated parts of the Gulf Coast. The scale of natural disasters are starting to take a financial toll on insurance companies, with losses already totaling $50 billion. According to reinsurer Swiss Re, that is the second highest in history. And as natural disasters have affected states across the country, insurers are opting to leave states that have been hardest hit. To dive into this more, we've got Sean Kevelin. He is CEO of the Insurance Information Institute. Sean, it's good to talk to you today. Between the wildfires in Hawaii, the number of hurricanes we have seen in the South, it certainly feels like it has been a really busy summer of natural disasters. What's been the conversation among insurers as these losses continue to mount?
Well, I think what we're seeing is the results of a trend where populations are moving more and more into harm's way. And then when you put on top of that either national trends or individual state circumstances, it can be problematic for insurers doing business. You have that overall national trend of inflation that you've been talking about here, and that for insurance perspective, replacement costs year over 3 years, right? The new normal year over 3 years, homeowners insurance replacement costs are up 55%. Auto replacement costs are up 45%. So high inflation rates that are really going to take upwards of 10 years to get into anywhere of a normal state. But then getting into the specific states, a state like Florida, which it looks right now like it's trending towards the East Coast, and southern Florida being one of the most populated or growing populations in the U.S., you've also got layered on top of that legal system abuse, fraud. That's running rampant in that state. In fact, close to 80%, 79% of all homeowners litigation resides in the state of Florida, when in fact only 9% of the overall claims for the nationwide trend reside in that state. So you've got a specific circumstance with insurance being regulated and placed in a specific state that's causing a big challenge to do business in Florida. California being another you mentioned with wildfires. But on top of the wildfires, insurers are having a difficult time due to antiquated regulation. Actually, they're not allowed to model in this day and age. They're not allowed to price reinsurance into the pricing of insurance, and they're not allowed to really adjust for inflation like we're seeing and we just talked about. So some extraordinary circumstances in some states, But overall, I think we need to understand that the industry is a solvent industry. It has about $1 billion in policyholder surplus, but it can't withstand some of the trends in some of these states.
So, Sean, is this something we're seeing it right now with insurers pulling out of California, some insurers no longer offering insurance policies in Florida? Is this something that we could then see potentially spread to other parts of the country?
Well, absolutely. I mean, in the case of the legal system abuse, now that Florida has actually passed some reforms, even though the system got about 280,000 cases dumped into it in the 3 days between when the legislation was passed and then signed into law, we're actually saying, Florida is a state coming near you. In fact, we're seeing trends that a state like Georgia might be vulnerable to more legal system abuse. We're seeing erosion in some of the reform that's passed in other states like Michigan and potentially Texas. So yes, these trends that we're seeing in Florida, they are going to be looking at other states. It's hard to drive around in this country right now and not see a lot of legal billboards right now talking about insurance claims. So that costs the insurance policyholders a good amount of money.
Sean, I know in the past we've talked about modeling for insurance and how closely that's tracking. We've heard over and over that the natural disasters we're seeing, whether there's wildfires or hurricanes, the scale and the intensity are changing rapidly. I'm curious how closely that's tracking with the modeling that exists for insurers. And is that updated modeling part of the issue as well?
There are some reports that are saying intensity is increasing. Now, whether or not using that word rapid is accurate, I'm not quite sure. If you look at it in terms of insurance losses, again, because populations are growing in some of these areas that are more in harm's way, that intensity is insurance losses. In fact, since the 1980s, insurance losses have increased 700%. So we are seeing that we're having more record years of insurance losses, in large part because of growing population. But there is statistics. In fact, our non-resident scholar, Dr. Phil Klotzbach out of Colorado State University, is seeing some of that intensity happening in the likes of hurricanes and other natural catastrophes. Again, insurance is modeling for that when it can. Unfortunately, a state like California, it can't do that yet. And so it's not able to really price the insurance at an actuarially sound rate.
And so what's the path forward? To what extent is this about working with state regulators if the reality is that these natural disasters, if you're looking at a state like California, wildfires, we are seeing year after year. Is there an economic model that makes sense for insurers to stay in a state like California?
Well, I think from the industry overall, we're seeing a shift from one that would detect and repair after catastrophe to finding new ways to predict and prevent. No one really benefits from that loss. Obviously, insurers and their business model don't benefit, but the insured, some of the losses that they may incur can never be replaced. So are there ways that we can create individual behavioral changes, community behavioral changes that can help communities become more resilient? Because if we want to live more and more in harm's way, then we have to build communities that can adapt to that and that can be more resilient. And I think that's where the industry is really focused on helping its customers understand how to better manage risk. If we're going to see increases in severity, then we've got to figure out ways to live differently, change our behaviors, understand how we're developing, where we're living, how we're even purchasing property. If you think about just property purchasing in this country, the risk factor really doesn't come into play until it's entirely too late and somebody's fallen in love with the transaction. So we do need to factor in risk management more and more to our everyday lives.
Yeah, still so many questions around where that modeling should be. Sean Kevelin, it's always good to talk to you, CEO of the Insurance Information Institute. Appreciate you joining us today.
Thank you.
Well, coming up, the closing bell on Wall Street. We're going to check in on the latest market moves and the top trending tickers. Stay tuned.
And that's the closing bell on Wall Street. Once again, all three of the major averages closing in the red. The Dow off just about 200 points. The Nasdaq off about 1%. This market check sponsored by Tasty Trade. We saw a number of tech names among the hardest hit in today's trading action. And some investors are a bit wary whether or not the Fed is actually done raising rates. A couple of strong econ data prints out before the bell this morning. Also commentary from the Fed's Susan Collins saying that, hey, maybe the Fed does need to hike more. We're seeing some of that worry reflected in today's moves. Worst performers, when you take a look at the sector action, technology, consumer discretionary, and real estate among the sectors in the red. All right, well, AMC shares is selling off after announcing plans to sell up to 40 million shares. The company is saying that it plans to use the proceeds, quote, to bolster liquidity, to repay, refinance, redeem, or repurchase its existing indebtedness here and general corporate purposes. Well, AMC was widely expected to do this after the court ruled last month that it was allowed to convert preferred stock into common stock. And Nikiko, AMC, the moves are so dramatic, right? A lot of just talk about what the company needs to do to right this business. Clearly, this has been a meme stock, a retail trader favorite now for a number of years. But when you take a look at the actual business of AMC, movie theaters, getting people back into the theaters to watch movies, it's not only dealing with the fact that it has not recovered from some of the pre-pandemic levels, but then also coupling that with the Hollywood strike that's going on right now and the fact that we're already seeing some studios push out releases to 2024. It's certainly a very tough time for AMC.
Yeah, Shauna, tough to say how much of AMC's stock actually trades on the fundamentals. Yeah. But you're right. I mean, at the end of the day, the fundamentals are not good for AMC. They haven't gotten back to pre-pandemic levels in terms of getting people back into the theaters. You've got the Hollywood strike. That means less of a pipeline in terms of movies coming up. And then at the end of the day, AMC just hasn't had a turnaround strategy in place. So much of this is about riding the meme wave. You look at where the company is right now, $9.5 billion in debt and lease obligations still. That's at least according to data compiled by Bloomberg. But this is a company that's really struggled to find its footing in terms of its fundamentals and where they need to go to really change the strategy in the face of what we have seen in terms of attendance in theaters. Well, taking a look at some of the airlines, as United, Southwest, and Alaska Air are sounding the alarm about higher jet fuel costs in the third quarter amid rising crude oil prices. Southwest now expects fuel costs between $2.70 to $2.80 per gallon during the third quarter. That's compared to prior estimates of $2.55 to $2.65. The airline said overall leisure demand and yields continue to remain healthy. And this comes, Shauna, as we've talked about sort of this peak travel where travelers are willing to shell out those high ticket prices. And this has got to be a headwind for the company. But I will say, when you think about where oil prices were last year, because they were very elevated, ticket prices going up, they haven't necessarily come down since. And so you have to wonder, what this means for the airlines who are riding this wave of consumers really wanting to go not just domestic travel, but international travel as well. Does this mean they have to raise prices, even more, or just sort of keep it at where they were when prices were at the peak last year?
Yeah, exactly. And then also what consumers are going to do if they're going to be willing to pay those higher prices if in fact airlines do decide to hike prices, because we've already talked about the fact that maybe we could potentially start to see a bit of a cooling here. We're coming out of the summer season. Yes, travel demand was very strong. We heard that from most of the airlines in their most recent reports. But heading into the fall season, we know that many of these airlines are not going to be able to charge the prices that we saw during the summer. Now adding in higher fuel prices, obviously a headwind here for so many of these companies. United, which has arguably been amongst the best positioned, just given the exposure that they have to international travel and the pent-up demand for people to travel internationally over the last several months. But United also one of those ones saying that they expect fuel costs now to come in $2.95 to $3.05 per gallon, which was much higher than expected. So we'll see what the airlines end up doing with this, if they do in fact hike their ticket fares, and then what that demand picture looks like. All right, let's also take a look at Overstock taking a big hit today. stock off, wow, look at that, just about 23% after reporting declining revenue at Bed Bath & Beyond. Overstock bought the intellectual property assets of Bed Bath & Beyond in June and relaunched the website on August 1st. There was a bit of good news in this update, though. Bed Bath & Beyond is adding customers and now have just around more than 4.8 million, but declining revenue here, at least in terms of sales, over the last several weeks since that relaunch on August 1st. They're seeing a decline in just about the mid-teens for revenue on a year-over-year basis, average order value falling in the high teens percentage base from a year ago levels. A lot of this, at least from an analyst perspective, is because of the higher promotional activity. They're doing everything they can to expand their customer base. And obviously, at least for right now, their sales, their revenue taking a bit of a hit.
Yeah, I mean, just because Overstock took over those assets doesn't necessarily mean there's an immediate bump, right? I mean, at the end of the day, Bed Bath & Beyond, went the way that it did because it was really struggling with the stores and being able to come up with attractive products and attractive value as well. So Overstock really taking on that problem themselves as well. I mean, you could argue it hasn't been very long since this all happened, so it still need a little more time, but it really points to the massive task that they have in trying to turn around these assets because it has been many years in the making.
It's been, yeah, certainly. It looks like it's going to be potentially a long road ahead. All right, well, the Federal Reserve's beige book noting economic growth was modest during July and August. We also heard from Boston Fed President Susan Collins warning that further rate hikes could be warranted as the central bank looks to bring down inflation. This all coming ahead of the Fed's meeting later this month. Here to dig into all this and more, we want to bring in Eric Friedman, U.S. Bank Asset Management Group Chief Investment Officer. Eric, it's good to see you. So certainly it looks like investors are a bit worried about what exactly the Fed is going to do next. What do you think has already been priced into the market, and do you think the market is getting it right?
Yeah, Shauna, great to be here, and you always do a great job on the coverage side of the Fed. I'd say that what's priced in right now is probably the optionality of one more hike at some point later this year, but probably not at the September 21st meeting. So we think that the Fed recognizes that this inflationary issue is likely to hang around like bad company, probably around the holiday season. So the concept that we're really focused on is what will the consumer be able to do as a great coverage on the airline front. We think that is a good corollary into the rest of the sector setup as well, because the consumer is taxed right now. They are facing higher interest rates. They likely will face higher interest rates for some time, and there isn't really much relief in sight. So we are seeing, again, we're very glass half full with a forward viewpoint, but we are starting to see some incremental chipping away, if you will, at consumer activity. And so if we see rates remain high and even get higher, which is certainly a possibility later this year, again, probably not in September, that could lead to even more headwinds for the consumer. So again, we think what's priced in is likely one more hike a bit later this year. The Fed wants to keep their optionality up as high as they possibly can.
Eric, when you're focused on the consumer, how dramatic a pullback are you expecting as we go into year end? I mean, this is typically, right, going into November and December, some of the busiest times of the year in terms of shopping around the holidays.
Yeah, it's a great observation, Akiko. It's one of those scenarios where we don't think this is necessarily a year where people are going to necessarily try to keep up with the Joneses from a spending standpoint. But we do expect to see that second wave of travel really be tested, both business travel as well as consumer travel. That's point number one. Is so the pullback we think will most likely be felt on the travel and leisure side. That'll be the first piece of evidence. We do think that the consumer credit card data that we're paying attention to is showing some weakening trends as well. Again, not massively weakening, but at the margin, consumers are spending a bit less. And when they are spending a bit less, they tend to extend credit, and some of their repayment activity has been slowing at the margin. So again, these aren't yet at concerning levels, but we think, again, the first step will be travel. The second step will be more consumer spending on other goods. Also want to point out that, we have to keep in mind that the replacement cycle for a lot of things we bought during COVID is starting to kick in. Normally, electronics have a 3 to 4 year type of replacement cycle. Hard to think it was only 4 years ago that we started sheltering in place, but that is upon us as well. So we're going to have a lot of good evidence to see what the consumer can do as we get deeper into this year and then early next year. We're glass half full, but we're certainly paying attention to some of the erosion happening at the margin.
So Eric, here we are today with the S&P still back below 4,500. What do you think the activity then looks like between now and year end?
Yeah, I think the range to pay attention to, Shauna, is 4,600 to 4,300. Again, we're again smack in the middle of that range right now. We're trying to climb above the 50-day moving average, which we gave away earlier today. That's about only 10 or 15 points higher than where we are right now. So use 4,600 as the level. That's the July highs. If we do see a breakout above that, I think the market would be indicating the consumer is going to hang in there for longer than expectations. Below 4,300, that's where we get some concerns about the consumer staying power and what spending trends may look like. So again, we would expect to remain in that range for some time. We think there's plenty of things to do in the market. We think you can get invested in energy. We think you can actually clip coupons to the short end of the curve as well. So use cash flow to your advantage in this environment. Really pay attention to that range. 4,300 and 4,600 is what we're thinking about from an asset allocation perspective.
Eric, what would be the play in energy? I mean, we were just talking about fuel prices going back up again. Is the expectation sort of maybe not at the levels we were last year, but a reacceleration on that front? Or is there a different play in there that you're looking at that you think adds particular value?
Yeah, it's been one of those sectors that last year, of course, was darling. Everybody loved it. And then this year, it's really struggled on a relative basis, especially given what growth has done domestically. But it has been, Akiko, one of the most capital disciplined sectors that we pay attention to. There used to be this almost Pavlovian response from energy companies that whenever oil prices ran up, you'd see exploration and production companies and super majors go out and chase more oil. And then they'd find more oil, and then there'd be too much supply, and then we'd sort of wash, rinse, and repeat that same cycle. Right now, you're seeing a lot of restraints from energy companies. And so super majors and the E&P folks, we think those are decent places to be, particularly super majors, because you're getting a cash flow yield back to you with also some upside participation. We got away with a cooler, I should say, a warmer winter last year in Europe. Again, we wish nothing but the best for the situation in Europe. But should that reverse itself, you would also have some optionality with super majors that are exposed there. So those would be places we pay attention to in the current environment.
Eric, what's your exposure right now in tech? We've sort of been trying to make sense of where the run-up has been. A name like NVIDIA, for example, where you could argue their most recent earnings reports really did point to the fundamental case to invest because of just the sheer amount of revenue that's pouring in from AI. How do you look at some of these big names that have really seen their valuations go up significantly now that we've started to enter sort of this show me phase?
Yeah, I think that the show me phase is a great phrase to use, Akiko. And one of the things we've been talking to clients about is really trimming and taking some profits in technology. If we look at the AI space in particular, it's not a very large value chain. Again, we're big believers in the technology. We think there's a lot of efficiencies and applicability. But the way you actually can make money or manifest gains in that particular sector is fairly limited. It's with a couple of the larger, unfortunately, I can't talk about specific names, but it's with a couple of the large mega companies, if you will. That value chain, the ecosystem is small right now. Again, it's probably more of a 5 to 7 to 10 year play. It's probably overhyped in the near term, but probably underhyped in the long term. So again, that's a space where we'd probably look to take some profits. We do think that areas like cybersecurity will retain a bid. We think that things like big data and companies getting more efficient, those are spots that you can still invest in. So, areas like CRM, areas like cyber, those are spots that we'd still be involved with. So again, we think the technology space is a spot that we want to have an overweight to over a long period of time. It's done really, really well. We trimmed some here. Again, we'd stay involved. But again, I think that those who think that there's going to be this continual disconnect between tech and the rest of the market, that's probably a little overhyped in the near term. So we take some profits at current levels.
Eric Friedman, U.S. Bank Asset Management Group CIO. It's good to talk to you today. Appreciate the time.
Likewise. Thanks so much.
Well, coming up, Brian Sazzi catches up with the CEO of Grindr to discuss the current state of the online dating industry. That conversation when Yahoo Finance returns. We'll be right back.
Welcome back to Yahoo Finance's coverage of the Goldman Sachs Tech and Media Conference in San Francisco. Let's dive right into the future of dating now with Grindr CEO George Arison. George, good to see you here. We last caught up with you during the IPO time. What's the state of your company and what are some of the biggest things you're working on?
Thanks for having me. It's great to be here. Yeah, we went public in November of last year, so it's been 3 quarters now that we've been public. And so far, it's been a really good run. We've had 3 really good quarters in terms of performance. We raised our guidance in August on both revenue growth and on EBITDA, which was really fantastic. So we're now saying we'll do 41% or better EBITDA, which I think is really good. And the team's been chugging along, producing a lot of really great products. So Grindr went through a period when there was a lot of technical debt that we kind of accumulated and that needed to be solved. That was done in 2020, 2021, and 2022. So now we actually have an opportunity to build a lot of a new product. So we've launched things like a new profile in the app. We've redone the homepage, which has been really great because now the app is faster, and I think people really wanted that. And we've been building a lot of features that people really have wanted for years that haven't kind of come in yet, such as making it possible for a user to say, I'm visiting this city in the future, and let's start talking to people there. That's not out yet, but it's in test, and it's something that people have really wanted for a while. So it's really great to be building these new features that people have wanted for a long time, but we've not had an opportunity to build so far.
Are you reinventing the platform?
Well, I think, honestly, for right now, a lot of what we need to do is catch up with our peers in the straight world, things that they've built a long time ago that we have not done, and users have been saying, hey, when are we going to get these features? So last year we launched Boost, which is a way to boost your profile where a lot more people see it. Tinder's and Match and Bumble have had it for years. We didn't. Users have really liked that product. So far a lot of it has been catch up. And we've also been then thinking about where do we take the product next. Grindr has really evolved where a lot of functionality is missing, but product is used in a lot of ways that functionality does not support. For example, travel is a really big thing on Grindr. Our users travel a ton. They chat to people in new cities to figure out where they should stay, where they should eat, what activities are happening. We should build functionality to support that. And so a lot of where we want to go in the coming years and quarters is building those kinds of features that are going to be more innovative. And then lastly, AI is going to change this whole industry completely. And so we're thinking a lot about how do we use AI to match people a lot better and to support the conversations that are happening in the product.
How do you see AI changing the future of dating?
Well, for us at least, Grindr is a very conversational product. Our users produce 500 to 600 messages a day on a daily basis.
A lot of messages.
It's a lot of messages. And so our thesis is that people are much more honest about who they are and what they really want in life in those messages than they are in the profile that you kind of see up front. And so I think one of the really unique opportunities is, with obviously users' permission, can we run an NLP on these messages, understand the user a lot better, and then say, hey, here are the 10 people who are actually really good matches for you based on your behavior patterns, on the things that you care about, on the things that you say in your messages and what they say in their messages, and introduce them to each other. That's not something we can do today. Today we are very geographic focused, which works really well in places where there's high density. But for all the gay and bi users in places where density is low, expanding the geographic kind of footprint for them to see people further away is a really big opportunity and will make their lives a lot better, I think. So that's one area. I think conversational AI is also a big opportunity because people do produce all these messages. So helping them craft those messages, make it easier to communicate, I think is something people will really appreciate as well.
One of your competitors recently launched a similar product. I think it was Match. Are you seeing them win any business? What is that competitive dynamic?
So users use more than one product in the space across all of us. Like people have a Tinder profile and a Bumble profile, even if they're straight, et cetera. So we know that our users use our products, and that's totally fine. We can expect them to have more than one. We just want to make sure that they're having a really good experience with us and are coming back to us frequently, which Grindr has very high engagement numbers, and so we feel really good about that. Where we probably need to do a little better is on the dating side. So Grindr started out as a casual dating product. Then it grew to offering dating as well, and friendships and travel connections, and even networking and social kind of business networking. So all that happens in the app today through the chat interface. But to engage in long-term dating on Grindr is a little bit harder than it should be. So we do need to build features that enable that a lot better. Obviously, Bumble, Tinder have those, and so it's a little bit catching up with them. But I think giving our users who want to find a long-term partner an easier way to do that is something that we definitely should do, and I think that'll be, that'll make it more likely people don't go somewhere else.
There was a lot of enthusiasm for your IPO. It came out of the gate, stock was doing good. Yeah, it was. but now the stock has been under pressure. Why do you think that's the case, and what questions are you getting from investors?
Well, look, what happened on the first day was uncontrollable and didn't really make any sense, partly because the float was so small. So kind of big demand with a small float raised the price so much. We are a very different business than most tech companies that go public, right? We are profitable, our EBITDA is very high, and we're growing at the same time. So we'll continue to have really good EBITDA while we grow, and that's something that we very much believe in, where we want to be best in class in growth and best in class in EBITDA in our category. So we trade in line with our peers, maybe a little bit worse than they do in terms of multiple, because our float is smaller and we're first year out as a public company, so it's expected that people want to see more results. But I think we're generally doing reasonably well versus where we should be, given where our peers are trading. The overall sector has come down in valuation, and so obviously that's going to impact you as well. What people want to know from investors' perspective is, what's the plan for sustaining this level of growth and this level of EBITDA over the long term, right? That's the story that we need to tell, and that's what we're spending a lot of time doing.
And it is sustainable? You think it continues into next year?
Again, we are very confident in our ability to sustain best-in-class growth and best-in-class EBITDA for the foreseeable future, not just next year, but many years after that.
Yep.
The app is very under-monetized. We're at about 7% paid penetration. Our peers are 2x and more than that, so there's a lot of room to grow monetization.
All right, well, we'll leave it there. Grindr CEO George Arison, good to catch back up with you and learn a little bit more about what you're working on over at Grindr. We look forward to continuing to chat with you.
Awesome, thank you very much.
Shauna, back to you.
All right, thanks there, Brian. Let's do a check-in of the market, see how things close. This market check sponsored by Tasty Trade. Dow closing off 198 points, S&P off just about 0.7%, Nasdaq down about 1%. Some fears that the Fed might not be done raising rates creeping back into the market. We saw yields push higher as equities came under pressure today. All right, well, coming up, we'll check in on some of the top trending stories of the day. Josh and Allie standing by with what's on tap. Guys, what do you have?
Hi, Shauna. Well, NFL season is right around the corner. He's excited. I'm excited. We're going to tell you how many Americans are planning to cash in.
And what companies they'll be cashing those bets in on, including 2 new companies entering the sports betting market. We'll have that for you next.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined by Josh Schaefer and Brooke DePalma. We have a few stories, but kicking things off with sports on the eve of the debut of the NFL season, I want to talk a little Warner Brothers Discovery. We know that they've been pushing this live sports option for their Max streaming service. Now Bloomberg is reporting that they're going to offer that as a free option for subscribers, but then come February or March, you're going to have to pay in order to access live sports. And Bloomberg says they're going to use March Madness as that linchpin to try and convince subscribers to pay up a little bit more for sports. It comes after they rolled out CNN Max, so leveraging live news along with sports to drive some of that engagement. And we know Warner Brothers Discovery, it's one of those companies, one of those studios that does have a big presence in sports, holding media rights to the NBA, the MLB. So you wonder if this could be maybe a core differentiating factor when you think about the streaming wars at large.
Yeah, a couple things that stood out to me in that article. One, I mean, they don't necessarily have the certain levers to pull, but if I was going to rely on sports to bring people to my streaming service, I don't know if the MLB would be my pick. Right. So they have MLB and NBA, and then I do think people will opt in to pay for March Madness, but those are just interesting, sort of tougher sports, especially in the fall. It'd be nice to have that NFL in there to pull people in. And I don't know, there's something to me that I think always rubs consumers the wrong way when you offer them something for free and then come back a few months later and ask them to pay for it. Right. Because that makes people think, well, I used to have this for free, now I don't want to pay for it.
But isn't it like a trial? Isn't it like a trial service? See if you like it, and if you do and you're frequenting it,
hopefully the service is good then.
Right. Well, yeah, exactly. I think that's
isn't that a lot of problem like newspapers and things have had, right? Is you give people things for free for a long period of time, and then you say, hey, it costs money, and then you're like, wait, I don't want to pay.
Doesn't stick.
But sports has never been totally free. I mean, the cable bundle was very expensive. That's why some people are still paying for their cable TV packages on top of all their streaming services so that they can access sports. So perhaps it's a little... for the consumer, maybe they want to.
Yeah, and what we're seeing here is so many other players get into the sports arena. We recently talked about that mega deal with Apple and the MLS. You know, Paramount offers live football through CBS. We also have Amazon Prime Video offering Thursday Night Football. And similar to that concept where they sort of bring you in for something that's free and then keep you hooked. I mean, this is not something that's new to Max, formerly HBO Max. I feel like they do this with so many series where people say, oh, I'll just sign up for, admittedly, I signed up for And Just Like That. I thought I was going to cancel after that. And then I still am paying for Max because they offer new things. They're looking to keep me enticed. And I feel like this is something that we could see come of this free offering.
The other interesting thing I'll add in with that, and you wonder how the writer's strike maybe plays into this, but when you think about March Madness being where they're going to turn that pay lever on, what are your originals that come out with that? You're going to get a lot of people that tune in for March Madness for sure, and you're going to get people to pay. How do you match that with original content, I think is sort of the next step for some of these streamers as they use sports to make people watch some of their other shows. How do you time the releases basically with the sports calendar? So, okay, March Madness just ended.
When does White Lotus come back?
Here's the new whatever starting the first week of April, right?
I mean, unfortunately, because of the strikes, I think that's going to be very limited. I also am curious the pricing that they're going to do and what is that price point to convince users to go towards sports, especially when we have Disney bringing ESPN fully over the top at some point. They are rumored between $20 and $30 a month, which is very expensive. I know that Disney's going to be watching this very closely.
And all these sports fans are gambling now. And a lot of them are losing money. But a lot of people are planning to gamble on the NFL this year. Again, it is the eve of the NFL season. NFL kicks off tomorrow. So the American Gaming Association out with their annual projections for how many people are going to bet on the NFL this year. We'll run through a couple of the key numbers here. 73 million Americans plan to bet on the NFL. That is up 56% from last season. And then when you take a look at how many fans are planning to bet, you can see that sorry, I lost my numbers here a little bit. 19% of U.S. adults plan to bet, while 35 million plan to bet online, and then 13 million plan to bet at a physical sports book, which is interesting because we talk a lot about online sports gambling, but there are still people going into these sports books to bet. To me, this is a story I'm working on right now that'll go up on our website over the weekend, but the biggest story for me of sports gambling right now is you have ESPN getting involved with Penn. And then you also have Fanatics, which is a giant sports e-commerce retailer run by Michael Rubin, valuation over $30 billion, private company. But are they able to disrupt what DraftKings and FanDuel have been able to build over the last couple years? I'm sure you guys talked to some of your friends about gambling. It's really kind of DraftKings and FanDuel and everyone else right now. And so are these new companies, especially when you talk about ESPN, that sports brand, Disney getting involved, can they disrupt what has become sort of two top dogs at the top is what I'm excited to see this fall.
And the loyalty that's with these companies, the loyalty that they've been able to build over the past years. I mean, it's only been a short run up to this 2023 season of how long sports gambling has been legal in the U.S. And to think about the white space that still exists, I think it's something like more than 30 states that's legalized. There's still, of course, many more to come. And I think also, too, it's, we were talking before, but I myself haven't really dabbled too much in gambling. I feel like there's so many other Americans who are similar to me that haven't done it yet. And certainly, as you know, I hear it, I'm like, this is insane. You need one person on a specific team needs to run 50 yards in order to then, get 2 touchdowns, and then you win $500 after betting only 10. I'm like, this just sounds so complicated. I don't know if it's worth all the money. Well, I do think these stats prove that there's just a lot more accessibility, right? You can do it on your phone. It's easy. There are more states that are legalizing this. It's in the news a lot more. You mentioned that Penn ESPN deal. I mean, that also involved Barstool, which I think got a lot of people curious about that. So it's just, it's definitely a presence right now. And this stat stood out to me. Self-identified NFL fans, so those fans that are constantly watching and tuning into football, 37% are projected to place a bet this year. That's up from 42% from last year. So pretty significant.
I would have thought it'd be higher. To be honest, it seems like that's just like where when you look when you look at where the broadcasts are going and stuff, it's so betting focused now. It feels like when you watch these games, they're literally talking about it, so you feel like kind of everyone's doing it. I don't know. I thought that number might be a little bit higher.
Well, to that point, I think we're gonna eventually hit a point where on streaming services and cable, you're going to utilize AI or whatever that you can bet in real time.
It'll certainly help if they get some of those big states like California, Texas, Florida, et cetera, to legalize and actually allow mobile sports.
And I know the NFL is leaning a little bit more into gambling, way more than they used to at least.
Definitely.
Another thing that's catching our attention today is that Chick-fil-A is introducing mobile order pickup lanes. And so drive-through may have just got a lot easier at the chicken sandwich giant. Basically how it's going to work is customers can go on the Chick-fil-A app, order ahead, and then head to the mobile order lane to pick up their order. Now, we've seen others do this. We've seen Cava do this. We've seen Chipotle do this. And we all know, at least I know, I've struggled to get into a Chick-fil-A. I feel like every time I go on a drive-thru lane, if I'm, going on a road trip or something like that, I'm always not willing to wait in the line. And that's what kills me. So this, maybe if I could time it out right, it may work.
I see a logistical nightmare. I don't know. I mean, we'll see. I'm like, obviously they're not.
Pessimistic McGee over here. All right, let me 85% of customers who use the mobile through, they're calling it, reporting that they were likely to use the service again. So 85%, so that 15%.
I mean, how many people say they'd use the drive-thru again? I know, but like, it's probably the same amount.
90% say their experience went smoothly. Now we know that Chick-fil-A is known to have those people at the drive-thru. So perhaps that ease those workers, those employees, really kind of keeping that smile on while you're maybe not so happy.
I do think that is key. Because they do have people there and they come up to you and they check in, so it feels like the process isn't as long as you might think. But I thought the geofencing feature is actually very interesting, and this might go to your point with waiting too long. But they can actually track when customers are close to the store, so that they know when you'll be arriving, so that you can prepare food quicker depending on where
Make sure it's warm when you get there.
It just feels like a lot for workers to balance. It's like
I know, it's like the drive-through, this, that, plus all these
think about how chaotic,
features.
A quick service restaurant can be in general. It's just putting a lot on the workers. It seems like, but obviously would be successful if you can do it well. Because I will say my favorite thing living in New York City is to do mobile order, and then you show up and it's already done, right?
Yeah, and this is something that
it is very convenient.
We're seeing it so many different. Of course, Starbucks is known for those mobile order pickups. I mean, especially here in New York, you go in the morning, there is
they basically
20
think you're crazy
plus
if you don't mobile order.
Exactly.
Like,
if you're waiting online at a Starbucks, it might be insane.
It is funny. Sometimes the mobile ordering at Starbucks, you wait longer because so many people are mobile ordering than if you just went in line.
Yeah, I have found that, especially during like 7 to 8.
Yeah.
I do that at drive-thrus all the time. At a place like Starbucks or even Chick-fil-A, just go in.
A quick service restaurant, you probably are getting that food faster than waiting in the drive-thru.
Yeah, and what I find so fascinating is that these mobile orders do tend to increase ticket sizes. I know that I'm more inclined maybe to add that extra fries on the side. We're seeing that as well in drive-thru. So
well, they're good at giving you the click-throughs, right? They're like only $2 more to add fries.
Right.
Yeah, why not?
I like it. Might as well.
I'm worth
Shake, I'll buy it.
So, yeah, and you know, we talked a little NFL. I know I'm going to be ordering shakes, chicken fingers all the time when I'm watching the NFL season. So we're all excited about that, but stay tuned to Yahoo Finance. We have much more on the other side of this break, including an interview with John Stankey, the CEO of AT&T. Stick around, we'll be right back.
Yahoo Finance is camped out at the Goldman Sachs Tech and Media Conference all week long, talking a little tech, talking a little AI, talking a little media. And of course, the biggest cell phone providers in this country have descended on this conference as well. Talk about what they're up to right now and ahead of next year. Joining me now is AT&T CEO John Stankey. John, good to see you again.
Brian, good to be here.
So you're here to tell me that the future is drones, right?
It's certainly one part of the future, yeah.
So talk to us. What is this? Why is it here? It's for those who might be watching this right now. It's a giant drone. You know why does AT&T have this in its arsenal?
Well, over 6 years ago, we started a public-private partnership with the government to create a first responders network called FirstNet that ensures that any first responder can get data communications whenever they need to in a time of crisis. Could be a hurricane, could be a fire like in Maui. We had to come up with a lot of different creative ways to meet the needs. And so we've got cell sites that show up on trucks. We have cell sites that show up in suitcases. We have cell sites that float around on blimps, and we have cell sites that we can put up in the air on a drone.
These are a little scary.
Yeah.
I like sitting next to these. The remote's not here, so these are not.
No, they're not going to turn it on, hopefully.
Yeah, I want to get asked back to the Goldman Conference.
But this is a good example of when we're in a pinch and we don't have a cell site or it's been taken out by a disaster. We can put temporary service up and get people communicating so that they can save lives and do all the things that they're supposed to do. And we've done a really nice job working with public safety to meet their needs. And we have a great, not only infrastructure that supports it, but a great services organization that's always on the spot helping them out in a time of crisis.
Now, part of your role is thinking many years in advance and putting initiatives in the ground today to bear fruit at some point in the future. Look at all the climate events we're having in the U.S. and around the world. Is this a business that you want to expand? Should there be more drones out there? And how will you be using these in
Well, it's been a really good business for us. We were underpenetrated in the public sector before we started this effort. We've now got 5 million devices that we've sold into various agencies and first responder entities that, it's good business for us around that. And it's a great way to keep people communicating as well. But you step back, a relationship of 26,000 first responder agencies is a big deal for us. Drones, we'll do whatever we need to do to keep them happy and on the network.
I was joking with you a little bit off camera. This feels like a deja vu moment. We were just here 1 year ago, and at that time, you had just sold off your media assets, and now it seems like you're a different business. Where are you at in terms of transforming AT&T?
Well, we're real pleased with where we're at. To your point, we've gotten a lot of the structural transaction work done, and we're now focused on being the best communications provider there is. And we're not there yet, but we're certainly working our way toward it. And while we've gotten the structural deal transactions done, I think a lot of credit goes to the team and what they've been able to achieve and execute during that period of time. Over the last 3 years, over 8 million new postpaid cell phone subscribers. We've seen over 3 million broadband fiber subscribers that have come on the network. Our service indexes, either rated by external agencies like ACSI or JD Power, as well as our own internal customer service metrics, have all improved. We've been able to generate more cash yield out of our business that you started to see in our quarterly results. That's good execution. And the team has done a really nice job of not only getting the transactions done, but getting the focus back on operating the business soundly. Our wireless business at the time that I took over had some gaps between us and the performance of some of the better, run companies in the industry. We've closed most of those gaps on margin, churn, revenue performance, and really pleased with the progress that the team's made in those areas.
We've been hearing murmurs recently about renewed competition price-wise for cell phones in terms of monthly bills. What's your take on the situation, and are you ready to get more competitive on price?
Well, look, we've been in a competitive industry for a very long time, and we still are. And we're offering, frankly, more value to a customer than ever before. If you look at the speeds that we're able to provide a customer, the utility that a wireless device gives somebody in their everyday life, the ability to use devices now as hotspots so that you can tether your laptop or your tablet with you when you go. Those are all great things. And customers are using 35, 40% more of the service a year ago than what they're used last year. And so that's a big deal. And when we do that, I think what we're able to do is drive value and sustain pricing. So I think our plans are incredibly competitive, especially when somebody buys into a family and has 3, 4 devices on an account. I think we're incredibly competitive today, and the industry is actually working on adding more value. And you see ARPUs improving, meaning the customer is paying us a little bit more. You see people staying with us longer. They're not churning off as fast, which is a sign of satisfaction. And you see us growing the business. Over $1 billion of incremental operational cash flow in the first 6 months of this year than last year. That's a good formula.
There are a lot of low-income households continue to struggle. We hear from the likes of a Macy's and Nordstrom. People are not paying their bills on time, credit cards, you name it. Are you seeing that with your monthly payments? Or consumers saying, you know what, I just can't make that payment this month for the cell phone?
Well, look, we have a high-quality customer base to begin with. And so it doesn't surprise me that maybe we were a little bit insulated from parts of the market that might be more value-oriented. But I think you should also step back and realize the government's done a nice job of putting support in place for people to have these critical communications devices. So the ACP program that provides $30 of subsidy a month, those people that are really in the position that you just articulated can apply for that government support. And we offer discount programs that match that. So broadband, 100 by 100 service, $30 a month, $30 of subsidy from the government effectively makes that free. Similar in our cell phone business, we have certain programs that we offer into low-income communities that allow them to take advantage of that subsidy. And as a result of that, we don't see that kind of problem popping up right now. And I think part of it is not only the reasonableness and the value of the product and the subsidy that comes with it, but it's kind of like air. You need to have your communications to get through your day, right?
Yeah, and I need my phone.
Yeah, so I think maybe there's lower priority things that may be the ones that are on the chopping block before a communication.
Right, so we're not buying that extra pair of socks, but we continue to pay for our bill. Okay, check done. Now, key to your turnaround is you've been able to cut out a lot of cost from your business. Can you give us a number on how much, in terms of cost savings in your model, there is left looking out over the next few years?
Well, we've taken $6 billion out of our run rate over the last 3 years or so, which is really good work by the team, and that's particularly impressive given it was done in an inflationary time period. We've just recently stated we're going to do another $2 billion, and I feel really comfortable about that. We're a big business. We have a lot of opportunity to manage costs. We're in the middle of a transition like many other companies are, a combination of new technologies like fiber and 5G that customers love. We have some technologies that were great for the last 40 years, but they've now served their purpose. And as we start to shed those products and services, costs come out associated with that. We're using technology like anybody else. Our ability to apply AI into our business to handle customer inquiries effectively, to do it both digitally online and in call centers where a customer doesn't actually have to speak with somebody to resolve their problem, to do our engineering better, to write code in our software organizations more effectively. That's taking costs out. So we have a lot of places we can go to run our business more effectively.
One more for you before I let you go. If you go to Yahoo Finance, you go to the AT&T ticker page, you'll see that the stock is yielding like 8%. Does that surprise you? And what's your message to investors that are looking at AT&T or looking at a treasury? Where do you go?
Yeah, it disappoints me. It disappoints me that maybe folks aren't willing to bid the stock up to what I think is the fair value, but I think I'm pretty pragmatic about it. And I think what's going on right now, as we just talked about, we're repositioning the business, doing a lot different. We're coming out of major transactions, and there's a little bit of a wait and see. We need to do what we say we're going to do and do it consistently. When we do that, if we remove some of these other exogenous things that are going on, like what we see happening with the controversy over lead cable that we believe is not accurately represented in terms of what the exposure is.
Looking into that.
Then the business will perform and ultimately be valued fairly. And I'm comfortable that will happen. And we just need to every day come in, run it well, do our best, and eventually the market will find the inherent value in the asset.
And no new update on the lead cable situation. My interpretation from the last earnings call, you were looking into it and something you've been monitoring for many years.
Well, look, we said when the article was printed by the Wall Street Journal that, number one, we care about the communities that we support and our employees, and we've been following the law and doing the things that experts felt needed to be done to manage lead effectively. And we still believe that, but we said we certainly want to be objective and understand if there's new information and new science. And over the last several months, we've been actively engaged with our regulators like the EPA in various states, as well as examining all the data that we can get our hands on to try to understand exactly what was the Wall Street Journal looking at. The data points that have come out since then, Brian, suggest that we were correct, that there isn't a public safety crisis or a public health crisis. We've seen the state of New York evaluate a site that the Wall Street Journal framed in their article. We've seen the EPA look at one of the sites. We've retested Lake Tahoe. We've submitted information on a site in Michigan to the EPA. All have come back and said there is not a public health crisis in any of those locations. And we'll continue to look and understand, but our point of view is the laws have been effective. We've followed the laws. If there's tweaks and adjustments to make moving forward, we'll of course make them.
All right, we appreciate you breaking that down for us. We'll leave it there. AT&T CEO John Stankey, thanks for always making time for Yahoo Finance. We appreciate it.
Appreciate you having me.
Thank you.
Thank you.
All right, much more ahead from the Goldman Sachs Tech and Media Conference. Straight ahead, do tune in.
Let's take a look at what's trending after hours. We got 4 stocks for you and all on earnings. Let's kick it off with C3 AI. That stock off just about 4% right now. The company actually posting better than expected results here on the top and bottom lines. But we're seeing a bit of pressure, and that's because the company warning that it plans to keep investing in generative AI and does not expect to be non-GAAP profitable in the fourth quarter. That's putting some pressure on shares here in extended trading. The company also, though, announcing some availability here of a new C3 generative AI suite, 28 new AI solutions. That's not doing much, though, in after-hours trading. Over the last 3 months, we're looking at losses of just about 17%. But this is a stock that has been on a massive run. You can see the run up in the name since the start of the year, still up just about 181% since the start of the year, riding that AI hype wave. All right, let's take a look at GameStop, a meme stock here, up just about 8% in extended trading. Sales beating the street's expectations, $1.16 billion, a narrower than expected loss. And this is a stock that has been quite a wild ride. You can see it peaking for the year back in June. Now, this move coming after the company announced the ouster of its former CEO, also the fact that it elevated Ryan Cohen to chairman. But ever since then, we have certainly seen it trend to the downside. So we're looking at losses there. Year to date, though, the stock essentially flat, up just about 1.5%. All right, let's take a look at American Eagle. Look here in the consumer and whether or not they're spending. And we're looking at losses of just about 2.5%. The company actually beating when it comes to EPS, revenue coming in line with expectations, gross margin better than expected, but we're still looking at a loss. And that's because taking a look at the 3-month gains, the stock has soared over the last 3 months, up just about 48%. So giving back some of those gains, lots of the expectations very high going into this report. American Eagle falling just short. And ChargePoint Holdings, that stock off 11.5% here in extended trading. Third quarter revenue forecast missing expectations. The company also announcing layoffs, planning to lay off about 10% of its workforce. Now, this stock has been under pressure. We know as Tesla made their charging networks widely available here. A name like ChargePoint has been steadily moving to the downside on the heels of that. Just what exactly that means for the business. We know ChargePoint has also longly been criticized here, largely criticized for their chargers not being too reliable. So all of that has weighed on the stock since the start of the year. We're looking at losses of just about 25%. It did close just above $7 a share.
What is closing time here at Yahoo Finance? Here's a look at some of the top stories of the day. Apple shares closing the day lower following a report that China has banned government workers from using iPhones for official use. The Wall Street Journal reporting this is the latest attempt by Beijing to cut back on reliance on foreign technology. The move mirrors actions here in the U.S. that includes banning TikTok on government devices and banning Huawei products altogether. Comcast is moving up the date to start negotiating its Hulu deal with Disney to the end of this month. The companies will start negotiating the deal on September 30th, months earlier than the original January date. Comcast CEO Brian Roberts announcing that news at the Goldman Sachs Communicopia and Technology Conference today. Disney owns 2/3 of Hulu, while Comcast owns the rest. And Roberts says Hulu is worth upwards of $30 billion. And FTX founder Sam Bankman-Fried losing his appeal to be released from jail while he awaits his trial. His bail was revoked last month after a judge found that he likely tampered with witnesses twice. That trial is expected to start in less than a month.
Well, here's what's to watch tomorrow. We will get jobless claims at 8:30 a.m. Eastern Time. Claims are expected to fall slightly from 235,000 to 228,000. Last week's jobs report pointed to a cooling labor market with the unemployment rate ticking up to 3.8%. Throughout the day, we will also hear from a number of Fed officials, including the presidents in Philly, Chicago, New York, Dallas, and Atlanta. Their commentary comes as investors digest the Fed's beige book, which did show slowing economic activity across several districts, and headlines from Boston Fed President Susan Collins that more rate hikes could be warranted. After the closing bell, we'll get earnings results from DocuSign, RH, and Zoomies. That's not all. President Biden traveling to India for the G20 summit. The president is expected to push for World Bank reform and more funding for climate change. That does it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here tomorrow. Have a good night.